All right, what is up, tycoons? What's up, traders? Super excited for today's video. We're going to be going over option contract hedging and how you can use option contracts to hedge your portfolio. This is something that's pretty relevant right now as we're still in a bear market. 2022 was definitely a very difficult time for a lot of people's portfolios. And 2023 could be just as rough, if not rougher. There's definitely the possibility we could, outperform. But, I think that it's a good time to start learning about option contract hedging. So we're going to go into that. We'll go over some key takeaways, the risks and costs of put options, as well as go over an example using the S&P 500 of how it would have performed, basically, based off of where the S&P moved, if it moved up 5% or if it fell 5%, etc. You can see how your portfolio would have actually been affected having a hedge on there. So the first thing we'll start off with is going to be the risks and cost of put options. Now, there's three important factors, all right, in the cost of any option strategy. Number one is going to be volatility premium. So implied volatility is usually higher than realized volatility for most securities. The reason for this is open debate, but the result is that investors regularly overpay for downside protection. Number two is going to be the index drift. So equity indexes and associated stock prices have a tendency to move upward over time. When the value of the underlying security gradually increases, the value of the put option gradually declines. But if you're using this as a hedge, all right, you kind of want the value of the put option to gradually decline, and you want your portfolio to, keep increasing, keep gradually inclining, right, and increasing. Now, the third thing is going to be time decay, right? So like all long positions, every day that an option moves closer to its expiration date, it loses some of its value. The rate of decay increases as the time on the left on the option decreases. This is also going to be your theta, right? So when it comes to the option Greeks, the time decay is going to be theta. And so a lot of people like selling option contracts really to collect premium from theta. And if you're not too familiar with options, right, a quick fact is that a call option gives the investors the right to buy the underlying security. So each call option is going to be a contract to buy 100 shares of the, underlying security based on whether it's a ETF or individual stock, whatever it is, right? Each option contract is for 100 shares at the specific strike price that you choose. Now, a put option gives the investors the right to sell 100 shares per contract of the underlying security at that specific strike price that they choose. Some of the key takeaways, all right, is a hedge is an investment process that protects your portfolio from adverse price movements. Put options give investors the right to sell an asset at a specified price within a predetermined time. Investors can buy put options as a form of downside protection for their long positions. The pricing of options is determined by their downside risk, which is the likelihood that the stock or index that they're hedging will lose value if there is a change in market conditions. Options tend to be cheaper the further they are from expiration and the further away they are from the money. We'll move forward a little bit, and we're going to go ahead and use SPX, the S&P 500 index, and go over an example here. And we can see, over 3 months, the SPX percentage change. We'll take a look at how the portfolio performed if the S&P went up 5% or even if it dropped all the way down 20%. So the first thing we're going to do is, let's say you own a $1 million equity portfolio for this example, and you're willing to spend 3% of the total portfolio value, or around $30,000 in this example, to hedge your portfolio over that time. If the S&P 500 is at 4,200 and the VIX is at 16, the cost of one 4,200 SPX put option that expires approximately 3 months from now would be about $11,500. For this example, we're using at the money strike price. And so at the money means that if the SPX is at 4,200, then the put option you're going to get is going to be at 4,200. That's what's known as at the money. And in the money put option would be something higher than 4,200, right? Meaning like 4,400 or 4,500. And an out of the money put option would be something like 4,000. Okay. So remember what they said, that, 4,000, an out of the money put contract would typically be cheaper than an at the money or an in the money put option contract. But for this example, we're using at the money strike price to obtain immediate downside protection in the event of a sell-off. With the around 3% that you've allocated for hedging, you could buy 3 SPX 4,200 strike put options for $34,500. Each SPX 4200 put contract has a nominal value of 420,000. So in order to establish a hedge that covers at least 1 million, we would need to purchase 3 of these contracts. This table below shows how hedging would affect your portfolio value upon the expiration of the 3-month SPX put options. So if you take a look here, right? So let's say the SPX, the S&P 500 went up 5%. Now, but before we actually run through this, I just want to mention, yes, this example is for the S&P 500, but you can use this strategy on individual stocks. All right, you can use them on commodity related ETFs. Okay, you can use them on a plethora of things and use this strategy not just on the S&P 500. All right, so let's jump back into it, right? So if the S&P 500 went up 5%, this is what an unhedged portfolio would look like, right? Obviously, it would be up 5%, and the value of SPX would be about 4410. The value of those S&P 500 puts are going to be 0. Your portfolio value is going to be 1,013,775. Okay, and you're basically up, right, about 1.37, all right, 1.37% versus somebody with an unhedged portfolio who's at 5%. So you see you lose a little bit more. You lose basically that 3% that you put in there. That cash is uninvested in long positions, and so you aren't able to capture that whole 5%. But let's take a look and let's see what happened if the S&P 500 fell 20%. Right now, if the S&P 500 fell 20% and it went down to 3360, right, the value of those 3 SPX 4200 puts would be $250,000, guys. This is that same those same contracts that we spent 34,500 on. So that's almost an 8x on the original money that you invested in those S&P 500 contracts. Now, your portfolio value is going to be 776,000. But once you add in the put options that you got, your portfolio is actually going to be up 2.44%. So in the, you can see that, of course, if you're hedging yourself, in a bull market and things are bullish and it goes up 5% in 3 months, you're not going to have that total gain necessarily, right? You're going to be a hedged portfolio is going to be up about 1.37%. But if you get a really dramatic move to the downside, that hedge portfolio, instead of actually being down 20%, right? So this is an unhedged portfolio would be down 20%. You're actually going to be up 2.44%. And you can either choose to exercise those put option contracts, all right, meaning because they're in the money, or what you can do is you can sell those, and now you have that cash available. You have this $250,000 cash available, and you can choose to reinvest at a lower price, or if you think it's going to continue going lower, you can hedge yourself again and wait for things to go lower to buy back in. Now, of course, I'm not a financial advisor. This video is not financial advice, and I'm not telling you that you guys need to do a 3% hedge on your portfolios. Rather, we're just going over a nice little example and trying to provide some information and some clarity. But as you can see in the example above, not only did the hedge portfolio maintain its value during the various SPX sell-off scenarios, but it actually resulted in a net profit for the overall portfolio in the -15% and -20% scenarios. The net positive change in the hedge portfolio during those scenarios was primarily due to the higher nominal value of the 3 put contracts discussed above. And, that's what we saw here and what we highlighted, right? Now, if things only went, if the S&P 500 went down 10% or went down 5%, your hedge is still going to protect you a little bit. And you can see if it fell 10%, you'd be down about 0.5%. And if it fell 5%, you'd be down about 2% roughly. Okay, so you can see, there's really only about one scenario, okay, where ultimately you really get hurt, or 2 scenarios, right? So let's say things are flat. If things are flat and the market is flat or the market is positive, then you're going to lose the value of those put option contracts, and your portfolio is going to be hurt a little bit. Okay, but if you get anywhere from a 5 to a 20% correction, having a hedge on your portfolio could actually help put your portfolio in positive territory, as we see through these 2 examples, or at least minimize the losses, where instead of an unhedged portfolio being down 10%, you're actually only down 0.5%, or an unhedged portfolio being down 5%, you're only down about 2%. Okay, so we'll move on to the next one here. And so we're going to talk about long-term put options. We talked about out of the money and long-term put options a little bit, but we're going to dive a little bit deeper into it. Investors are often more concerned with hedging against moderate price declines than severe declines, as these type of price drops are both very unpredictable and relatively common. For investors, a bear put spread can be a cost-effective hedging strategy. In a bear put spread, the investor buys a put with a higher strike price and also sells one with the lower strike price with the same expiration date. This only provides limited protection, however, because the maximum payout is the difference between the two strike prices. However, this is often enough protection to handle either a mild or moderate downturn. Another way to get the most value out of a hedge is to purchase a long-term put option or the put option with the longest expiration date. A 6-month put option is not always twice the price of a 3-month put option. When purchasing an option, the marginal cost of each additional month is lower than the last, meaning that the farther you go out, the less expensive theta is going to be basically on the option contract. And this makes long-term put options cost effective. When making the decision to hedge an investment with a put option, it's important to follow a two-step approach. First, determine what level of risk is acceptable. Then identify what transactions can cost effectively mitigate this risk. As a rule, long-term put options with a low strike price provide the best hedging value. This is because their cost per market day can be very low. Although they are initially expensive, they are useful for long-term investments. Long-term put options can be rolled forward to extend the expiration date, ensuring that an appropriate hedge is always in place. Keep in mind that some investments are easier to hedge than others. Put options for broad indexes are cheaper than individual stocks because they have lower volatility. And we talked about some of the pricing and risks in the very first slide here. And volatility is definitely one of the risks. And as they mentioned right here, broad indexes such as the S&P 500 or the Russell 2000 or IWM, right? Those are going to be a little bit cheaper than individual stocks because they have lower volatility. Now, here's an example of a long-term put option. So the following chart shows some of the put options available on the iShares Russell 2000 Index, IWM, the one I was just talking about. And so in June 13th, 2022, IWM was trading at 178.59. So you can see here, and you take a look, the 179 strike with 31 days to expiration cost about $627 per contract. Remember, this is an option contract for 100 shares, so you're going to multiply the 6.27 times 100, and that's how you're going to get your cost. And this is costing you about $20 a day. Now over here, if you take the 179 strike with 70 days to expiration, you can see that the cost is going to be $938, and rather this one is costing you about $13 a day. Over here, you choose the 180 strike with 189 days to expiration. This is going to cost you about $1,514 at 8 cents a day, or rather $8 a day. And over here, you choose the 180 strike with 371 days to expiration. Then you would pay about $1,892, and this would cost you about $5 a day. So you can see as you go further out in date, the contracts do get cheaper, necessarily not by price. Okay, obviously, almost $1,900 versus $600 is going to be, about 3 times the money. But when you take a look at the amount of time and the days to expiration, you're getting over 10 times the amount of expiration, the 10-time amount of days to expiration here, and you're reducing the cost by about 75% right here, versus a 20 per day, right? You're actually only paying about 5 a day right here. So in the above example, the most expensive option also provides an investor with the least expensive protection per day. This also means that put options can be extended very cost effectively. If an investor has a 6-month put option on a security with a determined strike price, it can be sold and replaced with a 12-month put option with the same strike price. This strategy can be done repeatedly and is referred to as rolling a put option forward. By rolling a put option forward while keeping the strike price below but close to the market price, an investor can maintain a hedge for many years. And that's something that a lot of institutions do. That's actually where the name hedge funds come from, is because initially these people were hedging their portfolios, and a lot of times they were using option contracts to do so. So hopefully you enjoyed this video about hedging and how you can hedge your portfolio. If you did, smash that like button and subscribe to the channel. Thank you guys for watching.